brought to you by IG. Still looking at higher interest rates here in the US. I know it feels like, inflationary prints are well under 5% now. Interest rates in the US are north of 5%. How could they still be rising? Well, projected for July's meeting, a 25 basis point hike, and they're starting to project even more chance of another hike past 5.5% here in the US at some point in 2023. And so interest rates continue to rise. They're not rising as quickly as they were at the outset of inflation in 2022, but still rising. And we'll see, of course, at the July meeting what the Fed has to say about the rest of the year here. But chance for not only a rise in July, but further on into the year. And usually you see a rising interest rate environment translating to more demand for that currency and stronger forex market for that currency as well, relative to all else equal. And we'll get to all else equal in a second, relative to other currencies globally. And for example, here, you have Australia's interest rates getting up to 4% and Japanese interest rates staying near 0%. And so if I can buy Australian dollars and finance my Australian dollars in short Japanese yen, I'm borrowing in yen at 0%, and I'm loading up on Australian dollars at 4%. Theoretically, you get paid that 4% interest annually at 0%, and then of course you have to include the costs for trading forex and everything else, which you should absolutely look into. But then also the price action, right? Because the markets are moving around as well, so some potential risk there. But theoretically, this creates demand, right? Higher interest rates often create demand and potential bullish action for currencies in that higher interest rate environment. So why are we seeing US dollars diverge from interest rates? You have the US 2-year looking like it's poised to make new highs. It's at least close to those highs that we were at in March of this year for US interest rates. Like I said, the Fed is set to potentially hike another 25 basis points in July, maybe even more, beyond 5%. And the US dollar has fallen from its highs of the fall and winter of 2022. Well, this gets into a little bit of that all else equal, right? Because in that example, if Australia raises interest rates to 4% and Japan raises interest rates to 5%, then theoretically the demand would be higher for yen. And we've seen some of this. Again, you could be getting that higher interest rate by owning US dollars and being short the euro or the pound. And that may have been working for the bulk of 2022. But as the UK hiked interest rates up to 4% and 5%, and the Eurozone now is up at 4%, that's why you're seeing that US dollar see some downside as the demand is increasing for those currencies. The interest rate environment is converging. And so some of those forex prices are converging as well to the middle of the range. That's why you're seeing, some of this downside here in dollar coming back to the middle of its range as global interest rates have converged. And then, of course, you see poor Japan there at negative 10 basis points, and their yen still getting beaten up pretty bad against the likes of the euro, the pound, and the US dollar. Another piece that makes this even more nuanced, and this is why the carry trade taking in that higher interest rate in that example in Australia versus Japan, theoretically, it's there, but also not only can Japan's interest rates in that example climb up to Australia's, but also Australia's can come down. And you're looking here at the US rate projections for the end of 2024. By the start of 2025, they're expected to be where we are now, 1.2% chance. And that's to say interest rates above 5% by 2025, the current market for Fed funds futures from the CME group is pricing in just a 1.4% chance that we're above 5%. And there is, I mean, theoretically here, a 99% chance that will be below 5%. And you can see the bulk of this distribution centered around 4%. And then also more than a 25% chance that will be below 4% here in the US by 2025. So it was something that maybe puts certain people off, oh man, this forex environment, it's so complicated with these different currencies and interest rates in one place moving higher, interest rates in another place moving lower, or what's going on here. But essentially, in the major forex pair world, there are a handful of major pairs. And so you're monitoring the US, you're monitoring the Eurozone, you're monitoring the UK, Japan, and maybe a couple of others. And you're really seeing how interest rates and geopolitics and everything are shifting in those general regions. And that's translating to one relative to the other. And so, yeah, maybe there are a few extra pieces compared to stocks and other markets. But a lot of this stuff is pretty well monitored by monthly inflation readings, almost monthly central bank meetings, employment numbers that come out, really helping you to consistently take in data and spit out where the forex market might be going. But yeah, we'll see here if the higher interest rates from the Fed in the short term turn to higher interest rates for the Fed in the medium and long term, and that could bring that US dollar higher. But if interest rates are rising in the short term just to fall in the medium and long term, and they stay higher in the UK or Eurozone or what have you, then that US dollar might not increase like it did in 2022. And that's what we've been seeing recently. So higher interest rates, not necessarily as black and white in terms of US dollar action recently. And that can make for an interesting trade. We'll see where it goes from here.